What's going on in silver now is not normal, and don't expect it to be normal. And it was in its old reality. And when it broke through that in several quarters, boom, it quadrupled in half in price, all compressed within a couple quarters. Again, on its own, wasn't associated with the copper move even. So we've seen these events occur in other markets where an old price reality, which has existed so long you can't believe it, you're bored by it. You think it's the real reality to live forever. It doesn't. And then in 2010, it was September of 2010, already going up in price, silver was in the 20s. And that spread also broke out over a ceiling that any idiot drawing a chart could see if you plot the spread chart the way we do. And boom, in 7 months, it doubled in half. Okay. Same thing happened this time, except even more clear on the spread chart, even a wider base spanning 10 years of ceiling of silver to gold. Couldn't get above that ratio, that percent. But when silver unleashes itself as it has now, I expect in the next couple of quarters, since that spread breakout, that probably you're going to see a dynamite move that will drop jaws. It's not going to be incremental. You're going to a new reality. And it wouldn't shock me that it's in several $100s. My minimum is like 200, but I wouldn't be shocked if it approached 500, to tell you the truth. And the November close broke out above it. Bam. Suddenly silver goes crazy. Well, silver's essential in that. Here, there, and everywhere, in micro form and larger form. You can't get rid of it. It's essential because of its nature of the metal. And so those demand factors are continuing to grow, and it's not been priced into silver, the supply-demand issue. That spread dropped to 4%. Okay, it had been living in an average of 25% for decades, up and down around that level, in its valuation to gold. And it dropped to 4%. I mean, what do you think it's going to do? Go to zero? Miners are worth nothing? Okay, that's effectively what it did. And since 2015 low, that spread has rallied up to 8%, just over 8, and dropped back down to about 5. Rallied just up over 8 again, and this would be 2021. The high reading then was 8.6%, and it fell back down again, and now it's back up to about 8.2%. So this is the third assault in that 10-year wide range of spread reading. Still very cheap. We're talking 8% now, okay, versus an average back in those decades of 25%. So it's still dirt cheap compared to gold. You touch 90 one more time, and the guys who've been selling that old 2011 high at $90 rounded off are going to finally realize, oh, this ain't working. And I think the silver miners could go berserk, just like silver does, and outpace the gold miners.
Michael Oliver's historic silver forecast. After 50 years in a $4 to $50 range, silver's breakout mirrors copper's 400% surge in 2005. The November spread breakout versus gold, identical to signals before silver's 1979 quadrupling, triggers a dynamite move. Logarithmic analysis shows silver's 10-fold range projects to $500. Gold's 8-fold pattern points to $8,400. Even at 6.5% of gold, 1979 ratio, silver hits $520 plus.
Go back to 1986 when the XAU index began. GDX only began in 2006, so it didn't have that much history. But XAU is the Philadelphia Gold and Silver Miners Index. It's not an ETF, it's an index. Back then, in the 1980s, 1990s, into 2008, so for multiple decades, if you divided the price of XAU into an ounce of gold, you ended up with the percentage readings that were on the bottom side about 17 to 18% would be low for the XAU value to gold. And the upper side was like 35%. So it lived in this almost 20-point range of spread readings, up and down, but holding its value at, let's say the midpoint of that's about 25% or so, okay? Quarter of the value of an ounce of gold. 2008, it broke down relative to gold on a spread basis. You could plot the spread chart, you could see the floor come out. And it dropped all the way by the bear market low in 2015, when both gold and the miners made their actual price lows. So if we're 8% plus now, and we're going to double, go to like 17, 18, just to bump the bottom of the old relative performance readings. And I think that's likely to occur fairly quickly. It's just like that silver gold ratio spread relationship that broke out in November. Poof, silver beat gold dramatically in price. The miners are now positioned to do the same thing. And my son Brett has pointed out to me, I didn't know this, but in February, there's going to be a lot of miners' earnings reports.
Miners are massively undervalued at 8% of gold's value versus 25% historical average. Oliver warns of a potential $100 correction, but stresses it's a buying opportunity before the electric move higher. With T-bonds near implosion and systemic debt crisis, he concludes, "This is different. Treat it as normal and you'll miss the move."
This time we got government debt crisis here, Japan, UK, etc., where the government bonds, the core of the asset world, could come into doubt. And, like President Williams of the New York Fed in mid-November made a speech or a press conference, and he said the Fed is going to start buying bonds. And his explanation for that was, and we know they've been, because you look at what they've been doing lately, they've been buying the hell out of. Okay. He said only because of illiquidity in that market. Not because they're afraid it's going to collapse, but because, and rates explode, but illiquidity. That's a nice way to avoid the issue. But they're very concerned about it. The Japanese are too. I mean, we have a government, we don't have a mortgage crisis this time. We have government debt, and that is bigger than the entire US stock market. And they've been buying and buying and buying since November, and bonds have gone nowhere except sideways. And our assessment of T-bonds right now, which is the quiet one, watch out for him. When he wakes up, he could do violent things. It's been 118 to 114 and a half for like since November. Right now we're trading at 116. All they're buying has not boosted the bonds. They've just gone dead sideways in price, meaning the yields on 30-year are at the highs, just sitting there, not breaking back down. No relief on long-term debt. And subgroups in the stock market like commercial real estate, which is a huge subgroup, which is a very anemic sector, has been going sideways in the middle for the last year, in the middle of its 10-year range. It hasn't made new highs with the S&P. It hasn't broken down yet. And everybody thinks, oh, well, it hasn't broken down. It must be okay. Watch the T-bonds, because if they roll over, like they're 116 now, you don't ever want to see 111 again. Look at a price chart and say, well, we've seen 110. What's the big deal about 111? Our momentum structures say you go there, you're going to get an implosion. Now, admittedly, they're going to come out with fire hoses. Bank of Japan, Fed, et cetera. Central banks are going to go ape, and they're going to print money like crazy. Well, what's the beneficiary of them destroying the money in it? Gold, silver, real money benefits from the decay of fiat money. And that's the history of gold and silver as well. So that's the other wave underneath here. And watch the T-bonds, because if they can't control that market and it slips just a handful of points on the T-bond futures, we're looking at March futures right now, 30-year bonds. They're at 116. You don't want to slip off even a couple points, especially 4 points, because they're going to blow the bottom out of it. You're going to have a panic in the bond market, which is not on anybody's horizon right now. Everybody's looking at what's NVIDIA doing. Okay, who cares? Yeah, NVIDIA ultimately is going to pay the debt for being the excessive sector, the AI sector, but it probably won't be the provoking one. And frankly, right now, we view the stock market as stable and likely on an intermediate basis to probably even go up a little bit more. Maybe get well into the first quarter before you see any rollover at all. And I don't see, by the way, what a lot of gold miners, investors are afraid of. Oh, if the stock market goes down, we go down. No, it doesn't. A few times in history, gold and miners suffered. So the ceilings come off silver, both in its relationship to gold and its own technical situation. So it's a monster. And if you don't treat it that way, and if you treat it like, oh, RSI is overdone, you'll miss the move. In fact, the fact is that if you do monthly RSI, popular so-called momentum metric, we ignore it, but it's popular. In the 79 to 80 move, RSI on a monthly basis got above 80%, which is the upper, overbought level for a year. So when it first got to 80%, if you said, oh, I'm out, it's overbought, you missed the entire move. From like the teens to 50. Okay, you missed the whole move. So take your norms, throw them out the window. We're not in a normal situation. That's our assessment. And admittedly, yes, if we get what we expect in the next 6 months, then yes, we'll be more cautious about perhaps locking in, especially leverage positions or call option positions. I don't think silver is going to ever collapse again. It may collapse from, let's say it goes to $400 in 6 months and drops back to 250. Yeah, it'll collapse. But going back down to this old reality is not going to occur. It's leaving it. It's going to much higher levels. And if you're not there for the next 6 months, I think you're going to miss it. It's a midpoint correction. We might get one. I don't know. These dynamics this time, remember, we're outside that box now. Those corrections occurred still within that $4 to 50 range. Okay, so there was a midpoint correction even in those surges. But we've come out of that 50-year range. So, maybe there will, maybe there won't. But I'm cautious that there could be. If you take an arithmetic chart, meaning a regular dollar chart of silver, and go back 50 years, you'll see that range, monthly chart, high, low, close. Okay, you'll see $50, $4, $50, et cetera, et cetera. If you take the dimension of that range in dollars, it's like a $45 range or so. Let's call it $50, okay? You add 50 to 50, the breakout point, you're going to 100. And we know that there's a lot of traders out there who like to play these big round number games. Like remember 3,500 on gold? They stalled it for 5 months there. Big round number, 3,500. Let's sell it. Silver was stuck at $35 for a whole year, late 24 to early 25. Whenever you get the round numbers, they tend to like to play games there. Well, it happens that that's an arithmetic, orthodox swing measurement of silver added to the breakout point, which say, hey, I'm going to go to 100, which is to double the range, okay? You could volt out of there, where suddenly oil becomes a component. It is a component of the Bloomberg Commodity Index, but it's the most lagged component within the entire Bloomberg, which is advancing now. The Bloomberg Commodity Index, as far as we're concerned, has begun a second major bull leg. Started in October, price of 106, we're now trading 113 or so. Oil is the weak component, but it looks like it has the attributes to do a real V-bottom type turn. And not only make an exhaustive low, a panicky looking low, like it's going to collapse to never land, and just turn out of there and shoot up, $20, $30 very quickly and shock people. So right now, our view on oil is don't buy it yet, but be inclined to think about that. Because especially if you can get that kind of panic low, where you hear nothing but on CNBC and elsewhere about how it's going to go to, it's going to 40, it's no good. Trump was right, all this stuff, where you could come roaring out of here in that market. And I'm not going to explain why. I don't know why. I don't care why. I'm measuring the dynamics. And it says I'm cheap. I'm cheap in relation to everything else. Like you said, silver versus oil. Well, how about if silver stays at that level, but oil goes up? And so silver goes up more and just stays at that. You get the point? I merged the philosophical thoughts of Ayn Rand, but took away her politics, which was simply limited government, founding father type notions, but still pro-government, having government, and substituted them with Murray Rothbard's economic politics, which are totally libertarian, meaning ultimately we can evolve away from that. No, we're not going to do it overnight. And it's not violent. No, it doesn't seem to work. We've gone through all kinds of cycles of extreme right, extreme left, moderate, and so forth, and they all tend to implode at some point because of errors they create.